When you sell a partnership interest, start with the default rule. Your partnership interest is a capital asset, so the sale usually creates capital gain or capital loss. On the EA exam, that word usually matters because two things commonly change the result. Partnership debt relief changes your amount realized, and Section 751 can recharacterize part of your gain as ordinary income. Computing gain or loss is the same structure you already know. Gain equals amount realized minus your adjusted outside basis. Outside basis is your basis in the partnership interest right before the sale. Amount realized is what you get from the buyer, but it's bigger than just cash. If you're relieved of partnership liabilities, that relief is treated like money you received. Here's the exam trap. Debt relief goes into amount realized, not into basis. So if your share of partnership liabilities drops because you sold your interest, that drop increases your amount realized dollar for dollar. Students often forget it and understate gain. Mentally treat it like the buyer paid off your debt as part of the deal, even if no cash changed hands. Now the big exception. Section 751 inch hot assets. Even though the interest is a capital asset, the IRS won't let you convert certain ordinary income items into capital gain just by selling your interest. If the partnership holds hot assets, part of your gain is recharacterized as ordinary income. The classic hot assets are unrealized receivables and substantially appreciated inventory. A clean way to think about it. You still compute total gain the normal way, amount realized minus outside basis. Then, you split the character. The Section 751 portion is ordinary income and the rest is capital. On the EA exam, if they mention unrealized receivables or inventory, your brain should immediately say, hot assets, ordinary income is hiding in here. A partner sells a partnership interest at a gain. They generally have to report all the gain in the year of sale unless the sale is treated as one of these: an opportunity zone conversion, a Section 1031 exchange, an involuntary conversion, or an installment sale. Which treatment allows the gain to be reported over time? Think about it. The answer is an installment sale. A partnership interest sale can qualify for installment reporting, so gain is recognized as payments are received. A tempting wrong answer is Section 1031 because it defers gain, but partnership interests are specifically excluded from like-kind exchange treatment. Also remember, any Section 751 hot asset portion is ordinary and can limit installment benefits. Cedar Ridge Partnership bought a rental duplex for $35,000. It made $10,000 of improvements and deducted $5,000 of depreciation. It sold the duplex for $50,000 cash and also received property worth $10,000. The buyer paid $1,500 of real estate taxes and assumed an $8,500 mortgage. Cedar Ridge paid $2,000 of selling expenses. What is the taxable gain? Think about it. The answer is $28,000. First, find adjusted basis. $35,000 plus $10,000 improvements minus $5,000 depreciation equals $40,000. Then, amount realized, $50,000 cash plus $10,000 property plus $8,500 mortgage assumed plus $1,500 taxes paid by buyer minus $2,000 selling expenses equals $68,000. Gain is $68,000 minus $40,000, or $28,000. The common trap is forgetting the assumed mortgage.